So what do we make about the equity market correction here? Well, a couple of things. The 10% decline for the NASDAQ is a correction. It's not a bear market. And we actually think we needed to see something like this in order to give a lot of investors, especially those on Robinhood and elsewhere, a reality check. Hey, this market doesn't move straight up. And I probably made the mistake of using the word weak holders in our brainstorm today. But I think if an investor is very short term in terms of time horizon, and starts buying just momentum, that's what we call weak holders. When the momentum turns, they're gone. And we, who are longer term holders, do like to see the market tested that way to see how low is low and how much of the recent buying activity is momentum driven. So that's interesting. Then we also know there could be a few more reasons for the market to be destabilized here. One, we are seeing a flare up in COVID as school starts. I just saw today that Temple has sent students back home. So has one of the SUNY campuses in New York. We saw that at the University of South Carolina, 27% of the students who were tested were positive for COVID. And I think there was another university as well, the University of Alabama, same thing. So, it could be that kids, children at lower levels are going to be sent home from school. And as we know, that's a burden on families where both parents work. So that could be. Another destabilizer here could be fears that we'll end up where we were in 2000. After the election, we won't know who is president until December, sometime in December. That's what happened. And the market was extremely unsettled during that time. Now, there is one big difference. Back then, we were in the middle of the tech and telecom bust. And so this was just another variable to push that market down. I don't think that's where we're going to be. I think we're going to be in a very strong economy, as I've tried to build up here around the time of the election. So I don't think, even if we do end up in a situation like that, it will be as damaging to the market. Nonetheless, I'm sure there are some people pulling some chips off the table. And the final thing I'd like to talk about today is valuation. This metric, the PE ratio of the S&P 500 right now, it's at about 26 times on this year's earnings and about 20 to 21 on next year's earnings. Now, we should be looking into next year. The market is a discounting mechanism, but to the extent a correction makes people a little more focused on the short term, they're looking at 26 times this year. And typically, that has been the top of a market when we've hit that mid-20s PE ratio. Now, we believe that if we are right, that the interest rate structure of the market is permanently, I should never say permanently anything, but for the next 5 to 10 years, below 5% at the long end of the curve, say the 10-year. Right now we're at 0.65. We couldn't be further away. But the market has always acted as though 4 to 5% nominal GDP growth is the normalized rate of growth. And in order to do a back of the envelope calculation on what's a reasonable multiple PE to pay, you divide 1 over 5 or 1 over 4. So that's 20 to 25 times. And so that's where we've stopped, this idea of a normalized growth rate around 4 to 5 range. If the normalized growth rate, however, is 2 to 3%, because we're in a deflationary world, thanks to the innovations that are sweeping through the world that are all deflationary in nature. The ones we talk about are 5 platforms: DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology. As they are sweeping through the world, there's going to be a deflationary undercurrent, even as unit growth is very rapid. That is highly positive for PE ratios. So if you do the inverse for 2 to 3, what you come up with is of course 33 to 50 times. So we do believe that the multiple structure of the market is rising, and that for those companies with rapid growth and very high margins, which many of these technologies have, the multiples will be surprisingly high. And they are. We've even had to adjust to some of the software as a service 2.0 companies. And we like to see a correction like this, test them. And we are going to be talking a lot more about this in the future. I wanted to come out and talk about it on a day or a week like this week, when it looks like the sky is falling to some investors, especially those who are fairly new to the market. So as you know, we keep a 5-year time horizon. The coronavirus pandemic has accelerated the growth rate and the adoption cycle of all of our innovation platforms, save for 3D printing. 3D printing has been hurt by aerospace and autos, but we think that's going to change as well. And that the acceleration that we're seeing has surprised even the companies themselves. Many of them in the last earnings season and this one are saying, hey, we didn't expect to see this kind of customer coming to us for 3 to 5 years. That's quite something. I believe, when history books are written, that we'll look back at the coronavirus as catapulting us into the new world so much faster than we ever could have dreamed, even ARC. And you know, we are all about 5 to 10 years out. We are surprised. So stay tuned. We think this market shakeout is a good thing, not a bad thing. We need these reality checks. We need to remind, especially younger investors, that the market just doesn't go straight up without a correction. We need these reminders, and so I'll leave you with that.